Nancy, it's good to see you.
Nice to see you. Thank you.
Where do you think we should start? What's been the most significant development in your mind in markets over the past week and the economy?
Well, certainly we did have a good month, good track of inflation readings this week, the three that Steve just mentioned. And the question is, why are we seeing this low in inflation readings? And 1 month, by the way, doesn't make a trend. I would agree. We need to see several more months. We would highlight that you are squeezing significantly the low-end consumer. You are starting to squeeze the middle-income consumer. If you look at the University of Michigan Consumer Sentiment Survey that came out this morning for the first part of June,
it was bad.
Middle-income, it's very bad. But importantly, it's the three pieces that were bad. Both the low-end and middle-income consumer confidence dropped sharply and are in recession territory. So that comes back and helps explain why you're seeing weakness in retail sales. There's a huge debate right now that higher interest rates are helping consumer spending, but then why are retail sales flat? Retail sales have been flat all year. Now, you are seeing strength in consumer spending on services, and maybe that is that upper income consumer that's doing that. But on balance, you are starting to see the economy deteriorate, and the question is why.
So, Nancy, before we dive into that, just a moment on the consumer sentiment. Mark Zandi was on the other day, and he said you can't trust University of Michigan. He called it a flawed survey. Says the Conference Board has been more around the 100 number that's its average, his long-term running historical average. Do you think there's just something fluky, whether it's politics or something else going on?
I just want to insert before Nancy answers. There's been a change in the methodology at Michigan that raises some questions about the last 3 months.
Yeah.
They've gone increasingly to a web-based source rather than a cell phone-based source.
Interesting.
It's a reason just to be a little careful, but I don't think, as Nancy's saying, it's a reason to discard a potential signal it may be sending. Pardon me for interrupting, Nancy.
No, that's okay. I mean, they said in their release this morning that indeed they tested both web-based and their normal way, and they have the same conclusions. So
okay, I didn't see that.
Steve,
good for them that they did that.
Exactly. There are different surveys. The University of Michigan is heavily focused on prices, on inflation. Conference Board is much more so on jobs. We're not in a recession right now, but what the U of Mich survey is telling us, quite frankly, is why the administration is having such a hard time. Price levels are very elevated, and that's squeezing that lower and middle income consumer. Indeed, inflation expectations in this report still remain somewhat elevated. And if you ask consumers, the reason your personal finances are getting hit is because of high price levels. Yes, it's very, very, very high as it was in the late 70s, early 80s, when we know the rate of inflation.
And your colleague Jake was on earlier this week, and look, he points out we are talking about levels, but even if you talk about price increases, the needs-based increase is running at a 6% year-on-year average versus 0 for discretionary. So let's pivot and talk about if you do think this is pointing towards an economic downturn. I'll give you another devil's argument for it. Dean Mackey was on yesterday saying consumer balance sheets are still in good shape, and he doesn't think that that's going to be the kind of thing where we see a very near-term downturn as a result of that.
So our theme is the economy's been bifurcated. And when you have a bifurcated economy, at the end of the day, you keep inflation and interest rates higher for longer because those areas of strength, high-income consumers, what's going on in AI, keep capital spending stronger for longer, again, keeps the economy moving ahead. But we've had 2 times in the past when we've had bifurcation, 1979 and 2006, 2007. And so these periods of high rates, high inflation squeeze that lower income consumer. Now we would argue that middle income consumer. And we know both of those ended poorly. We're not talking anything as extreme as that. But our base case is we will have a recession. It's been bifurcated up to now, but our base case is we'll have a recession, but not until the fourth quarter. Conference Board is telling you right now we're not in a recession. Classically, once you go into a recession, both Conference Board and U of Mich go down. And I would agree. Right now, we're not. But there are growing signs. We're deteriorating. If you look at unemployment claims, the unemployment rate, the work week, et cetera, there are plenty of signs that the consumer is getting squeezed, which is why retail sales have been flat.
I am not going to make the following points only because it's the weekend and I want to go out on a good note. But I would point out, Nancy, and I'm sure you have an answer for this. I don't know if we have time for it. But A, we are approaching, I believe, come June or July, a full year of wages running stronger than inflation.
Nice.
So real wages have been rising. There's also a bit of data that shows those on the low end of the income spectrum have actually done better in this go round in terms of the cycle on wages than those at higher ends of the spectrum. So all of that. Now, of course, if that were the final determinative factor, then we would never have a recession. So, I mean, but I'm just saying there is some, what do you want to say, runway, it would appear. People are downbeat, and we did a lot of work on this, Kelly. Even though they're downbeat like it's a recession and that's where their sentiment is, their spending has been relatively upbeat. Now, we will get the retail sales next week, and our CNBC NRF monitor, admittedly it is new, showed a pretty good bounce back in April.
I remember that, yeah.
We will see if that's the case, and I'll be the first to say, look, we need to be careful about this because it's a relatively new indicator, but it is using actual spending data.
Nancy, a haiku-esque last word?
Well, I would look at real retail sales. Again, they've been flat January, February, March, April, same level. Unit auto sales have been flat, sub 16 million units for over a year. If you look at company news, our economic data are obviously company data. If you look at Signet and RH, and I have a whole bunch of companies that are saying, ouch, they're seeing weaker unit sales, and they're seeing, Signet anyway, said they were going to see declining prices. And so right now the economy is bifurcated. There are areas of strength, particularly on the AI side, but we do see things deteriorating as we go into the end of the year.